Hello and welcome to another class by Professor Choi. Today we're going to be talking about GDP or Gross Domestic Product. Gross Domestic Product is a number that we use today to talk about the size of an economy. So it's the way we measure economic activity today. So we're measuring right now GDP, which is basically the total production and or income in a particular country. Before I start this chapter, one of the questions that I always like to pose is, do you remember the last time we had a recession? If you remember 2008, 2009, good. Do you remember the one before that one? Now, usually when I ask this question in my classes, some people can pinpoint the previous recessions, but most people talk about the Great Depression of 1929 or maybe the oil crisis in the 80s. As it turns out, though, there have been a few more. Here's a list. All right, now to find this list, I just basically went to Wikipedia and I put recessions in the U.S. I just went to Google and I put recessions in the U.S. And there have been 47 recessions in the U.S. since we signed the Articles of Confederation. Here are some early recessions. This is some 1800 recessions. And this is the recessions in the 1900s, or like where we are right now, the last 120 years or so. All right. The last one was the Great Recession, or basically a really long recession. It lasted about 18 months, and it was between somewhere around January of 2008 or December of 2007 and June 2009. It lasted about a year and 6 months. Right? Before that one, we had the early 2000 recession. Then we had the early 1990s. Then we had the early 1980s, the 1980s, the 70s, the late 60s, the early 60s, the late 50s, early 50s, 1949, and before that, the Great Depression between 1929 to 33. All right, if you're watching this in the year 2020, we have a recession that's obvious that has started as of March 2020. We don't know how long it's going to last, but the economy is definitely in recession. Unemployment, as a matter of fact, is already hovering at the same level as this is. It's only been about a month in it. All right, so one of the things that we need to learn is that economic activity comes in waves. It comes and goes. This is what one of the releases by the Bureau of Economic Analysis looks like when the economy is okay. So when the economy is okay, we have positive numbers for GDP growth, and the numbers are above zero. When the economy is in recession, and this is a picture taken around 2008, then the economy would show negative GDP growth rate, like you see here. Now, this behavior of economic activity declining, economic activity expanding, and economic activity declining, we call it the business cycle. The business cycle are basically alternating periods of economic expansions and economic recessions that follow one another. So, let's try to visualize the business cycle. All right, on this side, we use time. And on this side, we talk about economic activity. Now, GDP, by the way, was not the metric of economic activity. It's only been the metric of economic activity, accepted metric, since around 1993. So we can talk about output here instead, or changes in output. All right, so basically, how does it look? Well, looks like a up and down sort of thing. So whenever we're kind of like on the upside of it, and economic activity is increasing, we call that period an expansion. During an expansion, you normally see an increase in real GDP. You see an increase in income. You see a decreasing unemployment. And you see an increase in inflation. Then at some point the economy hits a peak. And we go into a recession. When we go into a recession, we're going to notice that real GDP decreases. You're going to notice that income decreases. You notice that unemployment will rise. And you will see a decreasing inflation. During expansion, things are good because asset prices tend to go up. During a recession, asset prices tend to decrease. Now, depending on how long the recession lasts, we're going to start calling it a depression or a long recession. Eventually, we hit a trough. And after we hit the trough, we start going back again. Now, at the beginning, we're not quite sure whether we're out of it already, because some of the data would show that the economy is getting better, but some other pieces of data would not really show you that the economy is getting better. So what happens is, instead of calling an expansion, we usually tend to call it a recovery. And then once we get to the level that we were before, then if it keeps going up, we call it an expansion. All right, so economic activity comes in cycles. We call it the business cycle. We have expansions, recessions, followed by another recovery by expansions, by recessions. And this has now been going on for quite a while. Now, what exactly is inflation? If you follow my entire series, at some point we're going to be talking about how to calculate inflation. Inflation basically is a percentage change in the price level from one year to the next, or the overall increases in prices. The number that we tend to use the most in the US, the most widely used number, also known as the cost of living, it's called a CPI, or Consumer Price Index. The GDP deflator is a better number, and we'll talk about that number farther on my series. But the GDP deflator is a better number for inflation, but it is not a number that you can calculate all the time. The CPI is maintained every month by the Bureau of Labor Statistics, and therefore it's a better number to kind of track inflation regularly. Now, what exactly are we trying to achieve in general over time? Well, what we're trying to achieve is, with the understanding that there are expansions and recessions, an economy is measured by its ability to grow over time. In other words, its ability to have more expansions than recessions. So something like this, where you have recessions, but eventually you recover and you expand. Then you have another downturn, but eventually you recover and you expand. Okay? So what we're looking for over time, with the understanding that there are ups and downs, is an overall growing trend. Alright, and that's what we call economic growth. Now, what exactly is the job of the government? Well, this is something disputed, even by economists today. But in general, most economists agree that the government is supposed to sort of restart the cycle. In other words, there are particular times when the government is needed in order to get the economy back on track, and therefore it is the job of the government to reallocate or move money around in the economy by transferring money from wherever it's being accumulated to whatever is needed. Alright, now what exactly is GDP? How do we measure the economic activity? Well, GDP is the market value of all final goods and services produced in a country during a period of a year. GDP only uses final goods and services, or the goods and services that are purchased by the final user, and that's because we don't want to double count a particular transaction. So GDP does not count what we call intermediate goods and services, which is really an input to another output. All right, let's talk a little bit about what is the difference between intermediate and final. So let's say that we talk about the different stages of production for a shirt. All right. At the beginning of the production of a shirt, for example, we have cotton that needs to be produced. So let's say that we have a cotton farmer at the bottom of the production. Now let's say that that cotton farmer sells the cotton to the next person on the line for $1. The person that buys cotton from the cotton farmer is somebody who turns the cotton into fiber. So it's a fiber manufacturer. Now let's say that the fiber manufacturer charges $2 for their product to the next person on the line. Now who will buy this for $2? Well, the person that will buy will be somebody who turns fiber into clothing. So it's the clothing manufacturer. Somebody like Nike. Now let's say that Nike charges the next person on the line $4 for their product. Now who will be the person that buys it after that? Well, it's the retail company. Now imagine that that retail company sells it to you for $10. Alright, now out of all of this stuff, how do we count it? Well, the way we count GDP today is we just count these 10. So GDP in this particular transaction is only $10. Now why is it $10? How come we don't count all of these? Well, the biggest reason is because what we're trying to count with GDP is production. And what we produced in this entire process was one shirt, which we sold for $10. Now those $10 that you bought on that shirt includes the profits of all of the other people below it. So it includes their cost plus their value added. So all of these are points or intermediate transactions needed to get to this final transaction, which is the one that we measured for GDP. So all of this stuff is intermediate, and the only final transaction, it's the one at the top. So this is the final transaction. All of these other ones are intermediate. Alright, now this is what we call the expenditures approach of GDP. So what we basically do is we count all the expenditures in the economy, and we count them at the sell point right here. We have pretty good information for this because pretty much every state in the union charges sales taxes, and they use those sales taxes numbers in order to collect this revenue information from companies on final sales. Another way to count GDP is by counting the value added or the income of each individual on this particular transaction. Now notice that the farmer added $1 to this transaction. Then the next person added another $1 to this transaction. Then the next person added $2 to the transaction. And then the next person added $6 to the transaction. If you add the 1, the 1, the 2, and the 6, it also gives you 10. And this is what we call the value-added approach to calculating GDP. So we basically add everyone's income at all stages of the production. Now technically the two numbers should be the same, but of course, since we have millions upon millions upon millions of products in the US, it's a little difficult to make sure that those two numbers match, especially since we don't collect them the same way. So this number here is collected by the Bureau of Economic Analysis, and they put it together using final sale information from retailers. Well, this one right here is being put together by the same people, but using IRS data or things of that sort, income information. The numbers usually don't match. We use this one as the most accurate one, and that's our best estimate for GDP. The final sales of all economic activity, only using, again, final, not intermediate products. Alright, you need to remember this particular slide. It's going to be crucial for the understanding of economic activity. So GDP is basically the addition of the consumption sector expenditures, investment sector expenditures, the government sector expenditures, and the net export sectors, which is basically exports minus imports. Usually, by the way, in some books you see an X for exports and an M for imports. Okay? Or net exports. Some books, instead of XN, they use NX. It's the same. Another way, again, to calculate GDP is to do what we call the value-added approach. In the value-added approach, you basically add all the different incomes at all the levels of the stages of production. Now, who's in charge of collecting GDP? Well, the agency in charge of coming up with this GDP number, it's called the Bureau of Economic Analysis, or BEA. And they provide one of the most important numbers for our economy, which is the gross domestic product. All right? This is the way real GDP looks when your economy is expanding. Again, this video is being done in April of 2020, and we don't yet have a release of GDP for the first quarter of the year 2020, which we expect will be bad. All right, now that's not the only information that the Bureau of Economic Analysis releases. They also have income information. They have international economic account information. They have trades information. They have direct investment information by foreigners. They also have income growth per state, income growth per county, income growth by metropolitan areas, and consumption expenditures numbers. All right. Again, the agency in charge of this is called the Bureau of Economic Analysis. All right. This is the gross domestic product using a metric called purchasing power parity. And this is where some of this stuff starts becoming a little controversial. Let me show you GDP nominal. Alright, so this right here is the list of nominal GDP by nation in the world. Notice, by the way, that the number's in millions, which means we're missing 6 zeros after that. Okay? So this number is $21 trillion for the US. Now this number that you see here for 2019 or 2018 or 2017, depending on who you're looking at, is the nominal GDP number. And I'll teach you how to calculate the nominal and real in a little bit. But the nominal number is basically the one that countries release. So it's whatever they say their GDP is. Then after that, we take that number and we exchange it to dollars. So we take the exchange rate to US dollars, and that's how we come up with this number we call nominal GDP. All right? If you use nominal GDP, this is the list of countries by nominal GDP. All right, now to give you an idea how big some of the states in the US are, let's take a look at GDP per state as well in the US. The largest GDP in the US so this map over here has the GDP in the US by state, and the largest state in the union, the largest state is California, and GDP is about $3 trillion by itself. Now, if California were to separate from the union and we would put their GDP on the list in the world, California will be right around here at $3.3 trillion, about the size of Germany. The second largest state in the union is Texas, with about $1.9 trillion. If we were to take Texas out of the union and put it as a country, it will go right over here, about the size of Italy. That would be where Texas is. Third largest state in the union is New York, with about $1.7 trillion. If we were to take it out, New York will be right around here, about the size of Russia. Florida is the fourth largest state in the union with about $1.1 trillion. And if we were to separate from the union, it will be right here, about the size of Indonesia. All right, again, this is using nominal GDP. There is another metric which we call purchasing power parity, GDP purchasing power parity. Now, what is the difference in purchasing power parity? Well, in this particular metric, purchasing power parity, what you do is you take $1, and with $1 you buy candy anywhere in those countries. So in other words, we take the value of the currency using a metric of a market basket of how many things you can buy with it. So for example, if you look at the GDP in nominal terms for China, it was 14 trillion, but then in the purchasing power parity metric, it's 25. The reason for that is because everything's half off in China. In other words, if you use, say, $5 in the US to buy a meal, in China with $2.50 you can buy a meal. As a consequence of that, they double the GDP to turn it into a purchasing power parity metric. So GDP purchasing power parity is a metric that tells you how much can you buy in that particular country with that GDP. Now, this of course uses a weight in order to turn those numbers differently. But again, this is if you were to use this metric of purchasing power parity, this will be the list of the size of countries. All right, let's talk about the difference between nominal and real GDP. Nominal GDP is the value of final goods and services evaluated at current prices. Now, in order to be able to calculate GDP and understand the difference between nominal and real, we got to start talking a little bit about math. All right? Now, nominal GDP is basically the value of final goods and services evaluated at current prices, while real GDP is the value of final goods and services evaluated at base year prices. So let's talk about the difference between those two. All right, so a couple of formulas that we need to know before we continue. Nominal GDP, or NGDP, is basically the summation of prices at time t times quantities at time t. T being any year that you want to calculate the GDP for. So let's say you want to calculate GDP for the year 2010, you will do the summation of prices in 2010 times quantities in 2010. All right, now if we're calculating real GDP tries to adjust for the problem of inflation. So it's an inflation adjusted metric of GDP. It's basically the summation of prices on the base times quantities at time t. So if we were to calculate real GDP for, say, the year 2010, we would use the prices on the base and multiply those times the quantities in 2010. All right. Now again, to work this out, let's use Excel. It works a little faster. All right. So let's say we want to calculate nominal GDP for the year 2010. Okay. Now let's say that we have these two products here, A and B are the only ones that we produce in this economy. And we have the prices and quantities for the year 2010, followed by the prices and quantities for the year 2011, followed by the prices and quantities for the year 2012. All right, now to calculate nominal GDP for the year 2010, we follow the formula that we had on the previous slide. The formula basically said that we're going to be doing summation of prices. So we're going to summation of prices in 2010, price times quantity, same year. So we're going to do equal this price times this quantity. And then we're going to add this price times this quantity. So again, for nominal GDP in the year 2010, we're just going to do price times quantity for product A, price times quantity for product B, and then we're going to add it. And that's the number. Now, if we were going to calculate nominal GDP for the year 2011, we do the same thing, but for 2011. We do this number times this number, price times quantity for product A, and then we add price times quantity for product B. If we were to calculate nominal GDP for the year 2012, we will take the information from 2012 and do price in 2012 times quantities in 2012. So price in 2012 times quantities in 2012 for A, and then we add price in 2012 times quantities in 2012 for B, and that's our number. All right, so this will be our GDP information for the year 2010, 2011, and 2012 in nominal terms. All right, now let's calculate real GDP. Now, real GDP is an inflation-adjusted metric. In order to calculate real GDP, we have to declare a particular year the base. You can choose the base using any year you want. It doesn't have to be any particular year. It could be any year you want. For simplicity purposes, I'm going to be using the first year on the list because it just makes it easy. Okay? So I'm going to use the year 2010 and call it the base. Now, once you select 2010 as your base, the only prices that you're going to be using are your base year prices to calculate real GDP. You're no longer going to be using prices for any of the other years. You calculate real GDP by only using the prices on the base. So real GDP for 2010 is going to be the same because you're using the same prices. So you do equal this times this plus price times quantity. Okay, so it gives you the same number. Now the reason it gives you exactly the same number, of course, is because we're using that year as the base. But in every other number, it will give you something different. So if we were to do real GDP for the year 2011, we now have to use again the prices on the base. So we got to do equal prices on the base times quantities in 2011, and then we add prices on the base times quantity in 2011. Real GDP for 2012 is equal to prices on the base times quantity in 2012. Notice again, that's our product A. And then we add for product B, prices on the base times quantities in 2012. All right, so again, notice this is real GDP. Now, what real GDP is trying to do is it's trying to get rid of this problem of prices, which can be inflated and therefore make your GDP look a heck of a lot better than it actually is. And in reality, you may have had an inflation year. All right, now let's take a look at the changes in GDP here so you understand why we do it. All right, so notice nominal GDP was at 241,000, then it went up to 263,000, then it went up to 293,000. And you look at those three numbers and say, okay, well, the economy was growing. But look, we have a problem here. Between the year 2010 and 2011, prices went up in both products, but quantities went down. When quantities go down, there was a decline in production. But because of the increase in prices, if you look at the nominal number, it looks like the economy was growing. In reality, though, the economy was probably shrinking between the year 2010 and 2011. Now, how would you know that? Well, you would know because if you look at real GDP uses the same prices, so it avoids this problem of prices going up or prices going down. So if you notice, between the year 2010 and 2011, this real GDP actually declined. And that's what real GDP is trying to do. Real GDP is trying to measure the changes in quantity and excluding the changes in inflation. So real GDP is our metric for economic growth in the US. As a matter of fact, the best metric we have for economic growth in the US is real GDP divided by population, also known as real GDP per capita. So economic growth is measured today in the US by the growth rate of real GDP per capita, or real GDP per person in the country. All right. Hopefully you now understand the difference between nominal and real GDP and can calculate it on your own. How do we measure the price level? Well, we measure the price level by using something called CPI, or Consumer Price Index. Again, if you follow my series of chapters on the next set, we're going to be talking a little bit about CPI and unemployment. The GDP deflator is really the best metric for price changes in the economy. It uses nominal GDP divided by real GDP multiplied times 100. So the GDP deflator is nominal GDP divided by real GDP times 100. That's what we call the GDP deflator. The GDP deflator is the best metric that we have for inflation, but it's really not the best metric to follow all the time, because we only calculate nominal and real GDP once every quarter in the economy. So you only get 1, 2, 3, 4 GDP releases every year. In order to figure out how things are doing, you need to have metrics that we can follow every month. So the number that we use usually for inflation is something called CPI, or Consumer Price Index, and that metric is maintained monthly by the Bureau of Labor Statistics. Now, what are some of the shortcomings of measuring GDP the way we do it? Well, the first shortcoming is the problem that we only measure transactions that happen, not transactions that didn't happen. Let's talk about the difference. Let's say that you take care of your own child at home. If you take care of your own child at home, that's actually economic activity. But let's take a look at the difference. Let's say that instead of taking care of your own child at home, you take your child to daycare. Whether you take your child to daycare or you take care of your child at home, either one is taking care of your child. The difference is that if you take your child to daycare, we measure that transaction because somebody received money. There was money exchanged. If you do it at home, we don't measure it because there is no money exchanged. So any household production in GDP is not measured. The underground economy is very difficult to measure because, of course, these people don't come out there and start talking about their sales and their revenue and how much profit they have. So it's all underground. So we don't measure the underground economy. GDP also doesn't measure leisure time. It actually measures work time. Now, how come this is important? Well, because a lot of people equate GDP with, say, happiness. And I don't think they're using the correct metric. GDP, if anything, measures work time. So it could be, in fact, a measure of stress. The more you work, the more stressed you are. All right, leisure time is what people really want. So people want to do whatever they want with their life. So leisure is not being measured in GDP. GDP measures work time. It measures production. GDP is also not adjusted for pollution or other negative side effects. It is also not adjusted for any changes in crime or social problems that may develop because of GDP. And it doesn't measure the distribution of GDP very well. In other words, income distribution, things like that. Alright, a metric that we used to use as the standard for the size of the economy before 1993 was this number called GNP, or Gross National Product. Gross National Product used to be the standard for the size of an economy before 1993. After 1993, we started using GDP. Now let's talk about what the difference between those two is, because we still keep the GNP number. Now GNP, or Gross National Product, is trying to measure the production of Americans all over the world. So American production regardless of where it is. So let's say that Apple makes something in China. Whatever they make in China, we're going to count it towards US GNP. If Ford Motor Company produces a car in Europe, we count it towards US GNP. If General Motors produces a car in Ecuador, we count it towards US GNP. Alright, so GNP measures production of American companies. Of course, if they're in the US, then we'll count it towards US GNP as well. Now, the metric that we're using today is not GNP, it's GDP, Gross Domestic Product. Now, gross domestic product uses production in the geographical area. So if this is the geographical area we call the United States of America, then any production inside the United States of America will be measured towards US GDP, regardless of whether it's produced by an American company or not. So when Toyota makes cars in the US, it's counted towards US GDP. When BMW makes cars in the US, it's counted towards US GDP. Okay? So GDP counts production in the US, while GNP counts production by Americans. Alright, these are all the numbers that are also maintained by the Bureau of Economic Analysis. I just wanted to give you a bit of an idea of how you calculate them. Also, we get to this personal income number. Personal income is basically a metric of how much money people end up with in their pocket. And then disposable income is how much money you end up in your pocket after you've already paid Uncle Sam. Eventually, disposable income becomes really important because disposable income is the one that we use in order to flow back into the consumption sector for economic activity. So we'll talk about the difference between disposable income and personal income in further chapters down the road. These are the numbers for GDP, by the way, a bit of a breakdown for the year 2012. And it's just to give you an idea of all these different metrics like national income, personal income, disposable income, and the percentages of wages, interest rate, and business profits and taxes in the US in numbers. Alright, I hope you enjoyed today's lesson on gross domestic product and the business cycle. Have a good one. This is another lesson by Professor Choi.